Good morning, traders. Good morning, YouTube. Bennett Tyndall here with TradingAnalysis.com, bringing you our Elliottwave Wednesday live stream. Hope everybody's having a good morning today. Futures are up pretty sharply, actually, following the move lower yesterday. So the Fed came out with a 50 basis point emergency rate cut just, 15 days ahead of the meeting. And, initially we saw a little bit of an algo spike to the upside, actually breaching 3,100 in the S&P. The market proceeded to move lower, kind of shaking out some stops, and we're starting to push higher. So let's go ahead and bring in the trading analysis team, and we'll see how everybody's doing this morning. Good morning, guys. How's it going?
Hey, Bennett. How are you?
Hey, Bennett.
Good. How are you guys?
Alex, Terry, what's
Good
up, guys?
morning. I don't know. Looks like my screen's frozen.
Uh-oh. Might need to reconnect to vMix there.
Oh, no. You know what that does, too, so...
Well, you were hiding your camera earlier, so maybe it's just stuck in
everything
a
was
loop
working
somewhere.
fine. Yeah, everything was working fine.
It's the technical glitches of the world. So, Todd, how you doing this morning?
I'm good. I'm good. How are you, Bennett?
I'm doing well. Doing well. Just watching the market push back here.
Yeah.
We had some fun in TLT on the way down, and had some fun in Salesforce. So just kind of sitting back and awaiting a possible secondary move lower that we've been after here. So we'll see how things go. Yeah. And as everything's good audio wise, any issues?
Yeah. Let me just check the YouTube page here. Yeah, pretty unbelievable move here. Looks like markets are receiving Biden on the ticket well. And go ahead, Terry.
I must say, I'm looking at the YouTube page, and I only got a blue screen over here.
Okay, let me try something for you. One minute.
Guys, are you guys receiving the video?
Yeah, 1 second. Let me give something a try.
In the pop-up chat. Sorry about that.
Okay. Are we back here, boys?
I believe
I think
so.
it's good. Yep.
Okay. Are we having the intermittent issues that we had last week, guys, on the YouTube channel? Is it isn't it out? Was stopping, but seems okay now. All right. Interesting.
Yeah, I'm wondering. The stream key settings themselves on YouTube. I'm wondering if there's perhaps some issues there. We're still using the single camera feed, and we're outputting plenty, so I'm not quite sure.
Okay.
This is the
all right.
the
Well,
second
let's just carry on, and we'll do some testing offline.
Sounds good. Just getting our GoToMeeting set here, guys. I do apologize. If you could interject some commentary while I square up.
Well, I think it's doing better than last week. Last week it was horrible connection, at least from my end. I couldn't even get my Optima program to run at the same time. So we'll talk about relative rotations, give you a little peek in what's been happening there. We got a new monthly rotation data now that it's March. So
new monthly bars.
Yeah, that's for your long-term perspective. And
so I'm very interested to see what the rotations are showing in terms of sector rotation, being that yields just dropped to new all-time lows. It's unbelievable, the move in bonds. So we're certainly seeing, I think, any moves higher, we've seen a return to technology, XLK, but you're seeing a pretty consistent bid in staples, utilities, and real estate. Those interest rate sensitive. Looks like fundamentally they're looking for fundamentally strong, low beta companies with a good dividend to sort of kind of weather this volatility storm. And this is I've only been doing this for 19 years in the markets. This is one of the probably the most sustained and highly elevated volatility patches I can remember. Coming from which is not all that surprising, because as I was doing speeches and stuff over the last couple of years at the Traders Expo, there was one slide that I really liked to show, which was the percent average true range, right? So ATR is the average high to low range over whatever chart you're looking at. But just like, just like when you're doing analysis, you should be looking at a log scale, meaning that y-axis is changed to percent. If you normalize and go to percent change on the Dow, going back the last 100 years, this was the lowest volatility in 2016-17 was the lowest volatility on a percent basis, high to low, month over month in over 100 years. So I think, even though I view the uptrend as well intact in the equity market, we're seeing a volatility mean reversion, which is we're going to have more back and forth like this. So I think, it even transcends the political climate or what's going on from monetary policy. We're simply seeing a mean reversion to volatility. So it's interesting day to day to watch the market swing back and forth, and whatever trades or investments you have, it certainly can be unnerving. But I think this was well overdue for a long period of time. So just my opening thoughts on that.
Well, instead of jumping into the S&P right away, let's go ahead and take a look, since Bennett's got these rotations pulled up. This is the monthly rotation, so we're looking at January, February. Now we just now started March, so this is going to be the data as of the end of February, and I'll animate this just a little bit over the last few months here. Right, so if we go back let's say to December here, as the end of the arrow here represents November data and the beginning of December, and you can see we had this sharp decline in all our defensive sectors here. They had moved really high up during the summer and early fall, and then around October it started to decline. But technology is like a shooting star coming up out of the depths with dramatic increases in both relative strength and momentum when relative to the S&P. You continue to see, some shifts here in utilities. This is the last monthly movement. Okay, so our last month, technology still pushing to new highs. Utilities had made a tick to the right. Here's utilities. So it had made a little bit of a hook here and started pushing in higher relative strength. But now look, the hook is reversed again. So in the monthly and the long term, these guys that are in this leading quadrant right now have higher relative strength and higher momentum than the S&P. And these are going to be your current market leaders. Okay, these are your current market laggards, right? There's energy. It's so far away from the group. It's pitiful, right?
And it's been that way for a long time.
Exactly. And discretionary even down here too. Financials, I want you to take a look at, we saw financials rising dramatically up into the improving quadrant just a couple of months ago. Major banks were doing very well. They were in the leading quadrant in our weekly sector, and then all of a sudden they started just diving south. We'll switch over to the weekly in just a moment, but I want you to note that the monthly on the financials, you see that sharp hook right there. That's the signal to that the longer term financial picture. I think several months ago they had the writing on the wall that said interest rates are going to go down, and that's going to press on earnings. Bank earnings are going to suffer for that. So let's go ahead and switch this to the weekly chart, and let me scale it in a bit here. So now we're looking at 4 bars in the tail. So this is 1 month's worth of data, and again, I'll rotate you back into the beginning of the year. In the beginning of the year, we had healthcare and financials, but you can see what I was talking about from that monthly. You can see the same kind of hook that happened here in a little bit finer time scale in financials, how they reversed out of this leading quadrant and we're heading south. There's that clock again. So, and here's the technology continuing to push further into the higher into terms of relative strength, and then even starting to gain momentum too, right? And so tech is losing a little bit of its momentum, but the relative strength ratio is so far out here. I think your leaders in this recovery are still going to be in this tech sector. I'd also take a look here in the communications. Now, we do see the defensive sectors, real estate, especially in utilities, and here's discretionary. They're coming up in the improving quadrant quite fast and quite dramatically, very sharp or very long tails here. All these are 4 weeks, right? So you can see the difference in the movement in the same period of time in real estate versus the same period of time in technology. Now, healthcare had its run in January. And March, seasonality, I think, plays into healthcare. Typically, March is an underperforming month anyway, and the same thing we're seeing here. But healthcare following financials down into this lagging quadrant. A little bit of movement up in industrials, but certainly not enough for me to get excited about anything there. So let's jump on over into this communications. I'm gonna switch over to the communications group. So this is the top 20 that I have in the XLC, and this is the same weekly rotation. And so our leaders, there's very few leaders. There's T-Mobile, and we've got Google down here coming up out of this weakening quadrant a bit. Anything again to the right of the center here means it's going to be performing better than the S&P. So, you know, guys, just because it's on the right side doesn't mean the stock is going up. Obviously, we're in a correction. We've seen the market drop 15%, rebound 10%, drop another 5%. Just like Todd said, volatility is in play here. But anything that's going to be higher in terms of relative strength and momentum is going to be performing better than the S&P in any condition, whether the S&P is going up or down. So just keep that in mind, right? You got Twitter. Twitter's really moving up here in this improving quadrant, and it is very high up in momentum, but the relative strength is weak. So I think it's still got some issues with its price action in the near term here. Now, semiconductors are usually what's been leading our technology sector, and we've kind of seen, if I'm gonna pull this back again a little bit, you know, back here in you know, just let's see here. Oh, we're looking on the daily. Let me switch this one to the weekly. There we go. Get this on the weekly. Yeah, the daily's got, you know, it's going to have quite a bit of rotation in it because of such volatile days here. This is your weekly in the semiconductors, and you know, we had semiconductors. So I pull it back here around you know, the end of November, early December. You know, the majority, all the semiconductors were the thing that's pulling the tech sector higher. It was the one group that I kept pointing out that all of these stocks are the reason for technology to continue moving higher. Later on, we did start to see some of the software groups pull in and start to take a little bit of a lead. But you can see as we're moving in through January, you know, the rotation is south in the semiconductors, in the majority of them, right? There's a group that are floating around inside this 2 standard deviation filter. But most of the semiconductors have moved down into the weakening quadrant. I will say, notably, NVIDIA is probably the best situated right now in terms of its price and price performance. This is the daily chart of NVIDIA, and you know, here, while the S&P dove all the way down to the 200-day moving average, you can see that NVIDIA bounced off its 50-day moving average and now is trading higher above that. So I would definitely keep NVIDIA in the portfolio. Really, any of these that are sitting out here to the right, even though they're weakening a bit, they're still, in terms of relative strength, they're still outperforming. So that's what we got. We'll take a quick look here inside technology. So inside the tech sector, our current set of leaders are Salesforce.com, Microsoft, Adobe. Here's NVIDIA, again, reinforcing the fact that it's 115% relative strength ratio compared to the S&P. Way out here. Apple's pushing a little lower. Apple is trying to weaken, but still, you know, we know what's going on with the manufacturing of the iPhone in China and all that, and there's an expectation that earnings are going to come in lower, I'm sure. than had we not had the coronavirus. So there's definitely impact in all of these sectors. A lot of this technology is in, you know, South Korea and in that area. So yeah, the chip makers could have some near-term issues, I believe.
Hey, Terry,
so Todd, is there anything specific you want to take a shot at real quick here, or I'll hand it back?
No, but what were you going to say, Bennett?
I was just curious if you could show me the tail on Microsoft and where that's been. If you could give me a little more, some longer history on that.
We can just pull in Microsoft. There you go. There's Microsoft, and I'm going to drag this tail back to 16 weeks. So there's 4 months, right? So there's 4 months of movement starting from late November. You can see that Microsoft was down here in this weakening quadrant. It never moved over into the lagging quadrant. It had its rotation and it reversed. I'll bring it further back. You can see where it came from. Here is almost a full circle, and that full circle started in March of last. Or sorry, that's the end. I don't know where it started.
It's kind of a great example of that rotation.
Sorry, here it is. June. Okay, started in June of last year. Here's where the full circle started. So it's made one complete rotation since about June of last year. Started up here in the leading quadrant, weakened, and then rotated right back up. And it's well positioned to continue moving higher. Nice northeasterly vector, meaning it's gaining relative strength and momentum simultaneously. So this is a good looking rotation here.
That's interesting. That was a pretty significant orbital it made there. And Microsoft is actually one of the charts that we can see a pretty discernible 5-wave move, even on the daily, off the highs. And I had an alternate I was going to discuss with you guys. So just kind of curious to see where that was falling. So I appreciate that.
Yeah, unfortunately, Optima doesn't have as good an Elliottwave integration as we have in MotiveWave. So I'll leave that to you, Bennett.
Nothing's
but here's just a regular price chart with 250 and 20-day moving averages plotted on it. You know, Microsoft had a pretty big dip, did not touch the 200-day, bounced off, is floating around the 50-day right now.
I was just going to bring that up, Terry, and just a real simple way to gain relative strength, or to gauge relative strength in here, would be just where is it in proximity to the 200-day, and almost everything broke the 200-day except the Qs, XLK, Microsoft, Google. Just looking at Apple here, Apple went right down to the 200-day. So technology held above.
Right. For the most part. Here's Cisco. You know, here's Cisco. Obviously, Cisco had been lagging for a while. It had already pushed below its 200-day moving average a long time ago, and it just continued to weaken. So, you know, Cisco was over here on the left. Right. So that just gives you a comparison of what happens between, you know, the stocks that are over here. Although they may be improving, they're just weaker, right, than the ones that are over here. So these are our near-term leaders right now.
Very good. Very good. All right. Well, I'm set up with the S&P here. Certainly appreciate the rundown there. It's interesting to see the movement out of Microsoft, given the possible alternate that I'm going to talk about here in a minute. So let's go ahead and switch gears. And anything else you guys wanted to cover sector rotation wise? Todd, Terry, Alex?
No. I'm just looking at what Alan was saying there. XLC, XLU, and so communications, utility, real estate were down at least on a % basis. Jan through Feb. That's interesting.
Yeah.
It's just
here's utilities. Utilities is racing to the lead right now. And you know, that's to be expected when you have an overall market correction, right? So you've got several of these: American Water Works, Ameren, Eversource, and Extra.
Let me just not push back on that, Alan. I'm curious to hear what you would say, and we're in talks to get Alan as a guest in the show. Alan is the head of the New York chapter of the CMT, the MTA Association in New York. So he's a professional in the industry. The percent drop in XLU you said was less than the overall market, but I would probably push back and say, isn't the percent gain prior to the February 19th top less than the overall market? You know, it's probably just got a lower I guess would be a lower beta compared to the overall market. I'm wondering on that. But you're right. XLU held above the 200-day. XLC did not. XLK, which is technology, did. XLY, which is communications, did not. And actually, XLY is holding the 200-day as resistance. So it's kind of a tale of, it's weird. It's like the strongest sectors in here from a relative strength point of view are utilities and technology. So talk about two diametrically opposed sectors. It just goes to show that I think they're pricing in the next technological boom, whether it's in AI and quantum computing and the chip technology on one hand, but we have chronically low interest rates, and those dividend-paying stocks are highly in demand out of utilities and staples. So I just feel like, yes, the volatility has been nasty over the last since February 19th, but I think prior to that, they're buying it all. I think that, I keep saying it. I think the market was underinvested in 18 and 19 from very heavy bearish sentiment. The market broke higher. Everybody realized they were wrong. I have had this discussion on CNBC on Fast Money multiple times, and just like, I Terry, not to diminish the importance of your work, but I think from a sector rotation point of view, I think they're just kind of buying it all in here because I think a lot of people had it wrong over the last 2 years, and then with that October low and the breakup through the highs, I feel like they're just buying everything. So I could be wrong, but just an observation from my point of view.
I think Warren Buffett was sitting on a bunch of cash, and I know he's grinning ear to ear buying bargain prices on a lot of good quality stocks.
I think it's 186 billion. Is that right, in cash? I saw that headline. I hope that's accurate.
It was pretty significant.
That's probably chump change. But yeah, you can see here on the daily plot of the utilities sector, they did pop below the 200-day, right, on February 28th, and then dramatically rebounded there, right? So that was utilities. XLY is consumer discretionary. See if I can get that chart to come up here. I'm having an issue here. XLY. Selected. There we go. XLY a little bit deeper. It took it to look. XLY 1, 2, 3, 4 bars, 4 daily bars below the 200, and is not yet popped back up. So there's your difference, right? Utilities 1 day down, right back up. I'm sure you'll look if we look at XLK, since that is our strongest. XLK didn't even go below it, right? XLK touched it, and then now you've got 2 days above it here. So
it was interesting. The Qs did the same thing. The Nasdaq QQQ, which I just did a video yesterday for CNBC and talking about a portfolio adjustment we made at Ascent at the wealth management firm. We eliminated Disney from the portfolio. It's been technically not very conducive position. Fundamentally, obviously, people are avoiding the parks and resorts right now. Half of the revenue comes from that. And we have a CEO transition going on as well. So we eliminated Disney, and the investment team, we allocated the money into the Qs. And the Qs, same thing. If it's not all technology, there's consumer discretionary, there's some financial exposure in the Qs, healthcare. But still, the 200-day moving average in the Qs was 202.23. Right now, looks like we're pre-market. We closed yesterday at about 209 pre-market. I'm not sure where we are, but we're quite a ways off that 200-day in the NASDAQ. So it was a leader on the way up, and thus far in this recovery, if you call it one, I think this is the sector that is continuing to show better relative strength. So we're 213.6 in the pre-market here with 20 minutes to go.
Very good. Let's go ahead and we got some members asking about covering the S&P count. So Terry, if you don't mind, I'm gonna jump in here and switch the screen over and talk a little bit about what's happening in the S&P. So, guys, at this point we've come full circle, kind of back to what was our original S&P interpretation. Gosh, dating back over 18 months now. In fact, I'm just going to go ahead and bring this over here. Switch screens one more time. This was the actual chart from October of last year. So this was this period of consolidation that we were looking at throughout the summer last year. And this is where we kind of identified that should hold, must hold zone. And we went to work in the NASDAQ actually and took advantage of that breakout. So from here, 28.95, we were looking for 33.15. And this is today. So we fulfilled that move. We ended up printing around 33.93, I believe was the all-time cash session high. So around 70 or so points above that 61% target that we had. And now we are rolling over. So from an Elliottwave standpoint, there are two different key interpretations that I see that are applicable in this particular market. And those apply to not only the S&P, but the NASDAQ, as well as SMH, which is semiconductors have been showing some pretty broad relative strength within this overall rally. So getting you over to our motive wave here, handy dandy piece of software for anybody interested in learning more about Elliottwave. But at this point, we see one of two possibilities. Possibility number one is that we have been right for the past year and a half, in that the correction that we are seeing is simply an ongoing fourth wave triangle, which would square up to the wave 2 flat. So dating back to the credit crisis lows in 2009, we have this beautiful 5-wave move in wave 1 of the cycle degree, a little 3-wave flat here in 2. A lot of people have a tendency when looking at this from an Elliottwave standpoint to call this 1, this 2, this a smaller degree 1, 2, 3, 4, so forth and so on. The problem then becomes you're presented with a pretty significant degree violation. The magnitude of this correction is significantly greater than this one here. So it wouldn't be appropriate to have a smaller degree correction that is a larger net percent retracement than its higher degree parent wave. So we think it's most appropriate to look at this as a flat. Not only that, you have a nice little 7-wing structure or 7-swing structure here in B, and a nice 5-wave move down here in C. So if we were to simply take into consideration the guideline that corrections of the same degree often tend towards equality in either duration or magnitude, and sometimes both, time elapsed in 2 compared to 4, and let me just go ahead and bring in this ratio. If we're looking at equality to time elapsed, we're looking at March of this year. A more common time extension of 4 compared to 2 would be the 161.8% extension of time elapsed in this wave 2. That would take us essentially into January of 21, which takes us through the election cycle and essentially into the next president taking office. Getting you off the weekly down to the daily and even further down to the 30-minute, last Wednesday we were talking about the fact that this move will ultimately be met with some sort of a corrective move back to the upside. So it was pretty clear that it was a directional impulsive decline. And as we know from the Elliottwave principle, corrections come in waves of 3, kind of at a minimum, unless we're dealing with a triangle or a complex. So seeing this 5-wave move, which we were expecting to kind of resolve into this correction to the upside, last Wednesday we presented a couple of different internal substructures. Sure, we could have counted a completed 5-wave move, but when you're dealing with a market that's moving on really such fear and kind of the fear of the unknown, right? We can't necessarily quantify the bottom line impact that the coronavirus is going to have at the end of the day. Not only individual companies' earnings, but global GDP. So I think a lot of that was just kind of a fear-driven move in the markets, and it's really not surprising to see it become even more fractal and ultimately kind of come to completion at what was the October low. So we had support there around 28.55. We see a pretty decent bounce. Getting off the daily back to the 30-minute, we also have this wave 5, which was 61.8% of the magnitude of waves 1 and 3. And we see the markets pushing back towards, at least this 61.8% retracement around 31.77 in the S&P. I personally am looking for a secondary short opportunity. We could absolutely see this B wave kind of meander, and in fact, getting you back down to this smaller time frame, this 3-wave structure here could actually turn into A of the B wave. It doesn't necessarily have to be all of the B wave. I think given the fact that this was just so sharp, We might kind of hang out in this B wave a little bit longer. If we were to, for instance, take into consideration the move off of the October 2018 low back to the December, this little three-wave move, that was pretty significant compared to A. So we wouldn't be looking at traditional, B versus A fib time extensions. If you were to look at that with our current move back, I mean, we'd be at, your typical kind of time relationship. So I don't think the markets are finished with the downside. I do think we still have additional selling pressure kind of yet to come. The alternative interpretation, which still has the same near-term implications, is this. That being, the correction did in fact come to completion at the 2018 low, and this three-wave structure here is simply wave one of an ending diagonal of our highest degree, or our cycle degree wave 5, not our highest degree wave 5. And that would actually kind of give us the right look to ultimately demonstrate equality of waves 5 to wave 1. Now, I've seen people call this a 5-wave move. I think it's pretty clear that's not a 5-wave structure. So just be careful if you're new to the wave principle and you're looking at this as a 5-wave move and trying to call this a 1-2 off the 2018 lows. I think you're a little hard pressed to do that. And really, this particular interpretation, that of the ending diagonal, which by the way was Alex's kind of discovery and interpretation, that looks a little more probable in the NASDAQ, just given how significant this B wave is relative to the A wave. But again, what are the implications for this being an ending diagonal? Well, we're still looking for a 3-wave move to the downside, and then met with a 3-wave move to the upside. So I don't think we'll really know whether or not we're in the triangle or an ending diagonal until we see this 3-wave structure off the highs complete, and then ultimately resolve into additional upside. What are you guys thinking?
This goes back to Todd's point about the volatility mean reversion, because when you're going to forecast that we're going to move in these 3 waves, we're going to have a lot of sharp ups and a lot of sharp downs in a much more frequent time period than when you have a nice trending market and an impulsive up structure. You have very low volatility, which you saw back there, like in 2017. That nice little run there is very low volatility period, and anytime you get into the sideways choppiness, that's the high volatility period.
Yeah.
Yep, absolutely.
It's funny. I mean, I think we started tracking this count, Bennett, Terry, Alex, I think it was November or December of 18. I think that's when we first proposed. Now there's no way we could have known it was a triangle. It would have been sideways. But it was, as soon as we went down to that end of 18 low, rallied all the way back in 19, it was pretty clear that that was a 3, and that's going to introduce either a flat or a triangle. I don't think we expected this B wave to be as elongated and extended. Well, it did do a 1.618, so that's not egregious. But this has been our count for what, coming up in a year and a half now.
Yeah, it really has. Ever since we took advantage, we saw this kind of completion, the September 2018 high. I was actually just going over this trade for the webinar that we have coming up this weekend. And right. I'll never forget when you were kind of showing Melissa on CNBC that possible move down. And she's like, really, Todd? And yeah. And that's, we got that 5-wave structure. We kind of got that 3-wave retracement, mid-November. We're going, hey, maybe this is a 4th-wave triangle. So I think you were spot on with that.
Just following the theory. Nothing, no skill on my end. Just following this theory that we love so much.
Absolutely. So that's where we stand. I'm not getting too excited about this bounce back to the upside again. I mentioned to you guys last week, like, look, we could have seen last Wednesday be the bottom of that initial decline. It could have continued further, and which is why kind of we felt it wasn't worth trying to be a hero and trade this retracement. You don't want to catch a falling knife, especially in this kind of sort of market environment. If you're looking to scale into equities on these pullbacks, absolutely, I think that's a fantastic idea. Take advantage of the moves as they present themselves. So I still think we
You
have
did
more
make a
work to
good
do.
call on that TLT. We did trade for our members,
Yeah, that was a lot
and
of fun.
that worked out pretty good. We actually adjusted the trade higher, and ended up netting a double in that, so or better.
Yeah, initially
And
we had the. Go ahead, Todd.
no, go ahead. You please.
I was just going to say, initially we had the 145, 150 and a half call spread on into the March 27th expiration. After putting the trade on, we were already looking at pretty decent profit there, and Todd came in and said, you know what, I think we're pushing higher in TLT. Let's go ahead and adjust that position. And so we ended up pushing to the 155 strike. So it was a 145 and a half, 155 spread. It was a good trade. It was a lot of fun taking advantage of that move in bonds.
Yeah, and it was going into it. It was interesting that even before we saw the February 19th top, bonds had just been moving up and rates had been dropping, and I think it was clear that we had an accommodative Fed. Interested to get Alex's take on this, and perhaps our interest rates are catching down to the rest of the world, where a large amount of debt out there on the global markets are negative yielding, and
Yeah, they get
possibly
paid.
we're catching down to the rest of the world. So it wasn't really it wasn't it could have been a hedge, because I was thinking bonds would move up with stocks moving higher or with stocks moving lower. I just think that this is one of the strongest trends out there. And, here we are with U.S. Treasuries 10s and 30s making new highs. And then we get a 50 basis point rate cut, which has just been unbelievable. So, I don't know. No real point there, except I think they were going higher either way, I think is my takeaway.
Yep. And, taking a look at both bonds and yields with our public blogs that I do weekly, we were tracking this fourth wave here in yields, and of course the corresponding correction in wave 4 in bonds. So we were looking for that push to new low in yields and a new high in bonds. I have to say, and I'm not going to steal Alex's thunder, I'm going to pass it to him right now. This move is looking a little bit interesting to be a wave 5. So I think with that, I'm going to pass it to Alex and let him bring us the update in the Forex world, and just kind of see how this is impacting things. So Alex, sir, are you ready?
Hey guys, yeah, sure.
Hey, all right, sir, coming your direction now. Bring us up to speed. What are you seeing?
Yeah, okay, so firstly I want to mention, as regards of the past, that we have been looking in our previous webinars, especially Todd was interested regarding the currencies, and we were kind of got a warning sign from this dollar-yen consolidation. If you remember from the last few webinars, so we are still in a sideways price market, but looking at the current structure, I still think that the wave count is valid. I have several options because this has been a very big consolidation, but we did receive through several yen markets a warning sign, and Todd was extensively asking about it, and I think we covered that, but as a probability, and now that probability happened. And also we said that these yields are actually going to move lower from this area here, and I have redone the current wave count on yields. I think we're going to go much lower in yields. So I think we're going to go down in 1, and this is up in 2, and we are in a wave 3. And I think that this is going to be a prolonged situation when the dollar is going to be weakening. And we expressed that on our members in Forex for the last basically year and a half, when we were calling the 108 107 gap as the final place for euro dollar. Okay, so 10-year yields, I look this as a third wave down. I'm seeing more downside, and basically I think that even we're going to go around 0.5, 0.6, maybe even lower in 10-year yields. So I'm already seeing probability that the Fed is going to do more cuts in this year. This is just how do I see the character of this Elliott wave structure. My alternate scenario will be the one before that. Actually, this is a fifth wave. So I'm going to extensively look for any type of invalidation of this structure to pick a bottom from yields. But from this standpoint, I think we have a lot of room to go to the downside on yields. Okay, so that's the first thing. Second thing, euro dollar is bouncing very strongly from our support levels. On the higher time frame, I am looking for two options here. As you can see, we are very well contained in the parallel channel. This is one of the scenarios when we going to have a triple zigzag. And looking the yields and current situation, that the Fed has a much more room to go to the downside, and the ECB really doesn't. They can just expand a little bit more a bond buying program. There is no sense of pushing the European Union into officially negative rates, which I don't think they're going to do. And they can just lower deposit rates for banks, which is also obsolete because they have a tiering system. They can do maybe a minus 0.10 basis on a current 0.50. And I think that they're going to just next week expand a bond buying program, but not for much. So I see euro higher, and on our membership, we are looking for an entry. I think from lows, we have a nice five-way push on the upside. And I think this might, as you can see, gap is covered exactly there, Macron gap. And now we count this as a 1, 2, up in 3, 4, and 5. I'm looking for a pullback, and I want to buy this pullback on euro dollar. I'm going to show you also one more thing on this dollar yen. If the yield starts to push lower, this scenario is also viable. But if we found the move, because dollar yen is not moving much as the S&P, guys, as you can see here, and it was very strange to me because if you have a 15% move down in S&P, the dollar yen should be trading around 100, and that was expressed actually in the Aussie yen, which went below this 70 level. Dollar yen really didn't move much, which raises a question for me: are we going to do just ABC, market stabilize in next few months, and we do this triangle B and we go up? I'm just saying what I'm also looking in a case we do a shorter term correction in the stocks. Okay, my main option is here, that we are still going to revisit this 96, 94 levels. But look at dollar yen and gold. This is very interesting. I have been pointing out that we have a big divergence for already a lot of time between dollar yen and gold. So somebody is going to catch up, and for now it seems that dollar yen is going to catch up. Okay, so this is a big divergence.
By the way, just want to point that out on the scale that you have the gold inverted there. So.
Yeah,
yep,
yeah.
good point.
Gold is inverted. Yeah.
Good point.
So also, I want to say one more thing regarding the gold. We have been juggling with the bullish count already some time, and this is now becomes a probability. Okay. On our bearish wave count, we stayed this and pinned perfectly these levels here. But if we start to push a little bit upside of this 786, I think looking this dollar yen chart and yields down and stocks down, we might see gold even go to possibly above 2000. I will just say moderately. I don't like to make big predictions. I like to go step by step. But this is now becomes a reality. Okay. We are not backing down. We had selling from this 786 last week, and everybody was going crazy. Gold is selling. Are we gonna blah blah blah? But look, if we're gonna go down in yields, Fed further easing, gold is gonna push up. And I think we're going to go above this 786 very soon, as the euro, as the Aussie dollar, as many other currencies versus dollar. Actually, the most gainers yesterday was the EEM currencies. So we have been seeing yesterday a big gains in the Turkish lira, South African rand, dollar, and some other EEM currencies. I didn't look the whole board. I have only these ones. Dollar NOK, although the oil just retraced a bit, it can be ascribed to that. But I'm just saying, if we are predicting dollar weakness, I think this can be seen through many charts. And I'm looking for an entries also in Aussie dollar, maybe a little bit move downside with copper. And I want to be long this rush passes. I want to belong some of the currencies against the US dollar. So if you look the cryptos, switching to cryptos, actually cryptos reacted negatively. And if you remember, we have shown this chart many weeks ago that actually S&P might catch up with the cryptos, if you remember that. So you have seen that cryptos was diverging few times, and S&P actually every time did a catch up. Okay, so we did diverged here. S&P went higher, Bitcoin went lower, but later in 2018, S&P did a catch up, not catch up, but catch up. Okay, and now we also kind of doing catch up to the Bitcoin price. So maybe there is some correlation between the cryptos and the stocks, because looking at this chart, the S&P and Bitcoin are relatively quite correlated. If you look the current picture. So on cryptos, I'm still looking this to be WXY. There is also a little bit more bearish scenario, which I'm tracking very extensively, because if we do a 5-wave move here without overlaps, I will quickly switch to bearish one, moving us back to 4,800 levels, where I'm going to buy a cryptos for term hold. If we start moving up in 3 waves, that will be an X wave. I expect 7,000 or 8,000 to hold. So I think that S&P and cryptos are correlated, and I'm going to track and try to see when the S&P is going to actually find any kind of a backup or some support levels. I actually look weekly, 200 weekly MA for S&P. That will be my kind of a nice zone. So it is also on cryptos. If you look, there is a possibility we are also in a triangle, a big triangle, as the S&P as well. So this is also interesting. So these cryptos are really correlated, and we are tracking this quite successfully up to now. Many of the guys was taking this move as a quite bullish and piling up on cryptos. But it might be very soon the case, if we see 5 waves down, that actually we're going to move back to 4,000. So this what happens here in the next few days is going to be extremely important for the next 2 months or 3 months, what is going to be on cryptos. So watch out, guys. If we get a 5 waves down, we might end up moving relatively much lower than usual media is putting us.
Very good, sir. I appreciate the update, Alex. Looks like we're 6 back from you, if that's all right. And
sure.
Yeah, markets are open big.
Minutes into the open here. Just to quickly address a couple of the questions we had. I'm gonna.
Aren't they?
Whew. Yeah, decent move. So the question was, is there an alternate S&P count that would support a move to 1,800? And the only way to look at this as a completed 5-wave move of the cycle degree, thus completing the higher degree wave 5, which would tracking kind of on our historical count. So this weekend we have a webinar Saturday morning in which I'm going to be looking at the S&P 500 wave count dating back to the late 1800s, essentially since its inception. But the only way to really look at this, and let me get you down to the weekly, given the fact that off the 2018 low, you have a pretty straightforward three-wave structure, that would then have to go back to the idea that the correction came to completion in the form of the Y-wave triangle, and then the wave 5 was essentially everything that we've seen from October of last year to the high. And when you just kind of take a step back and consider the fact that we have a nice extended third wave here, which was a nice 161.8% multiple of wave 1, more often than not, you will see when you have an extended third wave, waves 5 and waves 1 will often tend towards equality. So you'll see the magnitude of wave 5 often be equal to the magnitude of wave 1. If that were the case, equality of waves 5 and 1 in this particular count, where we have this wave 4 anchored, we're looking at 52, 12 here. So I really don't see this as the top of the cycle degree wave 5. If that were the case, certainly that would call for a pretty significant three-wave structure. But given the totality of our analysis and all of the data that we have available and at our disposal, I just don't think I don't think that's the case. I think worst case scenario, we're back to the triangle count, which has been our count for 18 months, and we'll happily trade it as it develops. And best case, we're in that leading diagonal, which is still going to be a little bit volatile. But again, implications are the same near term. I could show you 3 wave counts right now. All 3 would have the same near term implications in the S&P. So 1800, just not in the cards for me. All right, guys. Anything else we want to add here before we wrap it up and send them on their way?
No, you mentioned a webinar coming up on Saturday. You want to throw a sign-up link for the
absolutely.
Guys?
I'm going to put that in the chat right now for anybody who's interested in checking that out. It's TradingAnalysis.com.
Yeah, you can never get enough of us, guys.
TradingAnalysis.com/stocks. That's going to be March 7th. That's this Saturday, 11 Eastern. So yeah, hope to see you guys there. We'll probably run about an hour and a half. I'm going to give you guys what I call the Elliottwave fast track, get you up to date and up to speed on the 5 core patterns of the wave principle. We're going to look at our historical analysis of the S&P. We're going to talk about a trade that we're looking to put on as a team, and then we're going to kind of wrap it up just discussing how your investment time frame really determines your opportunity, and especially in a market environment such as the one we find ourselves in now. So the link is in the chat. Hope to see you guys there. And gentlemen, it's been fun. Members, we'll see you in about 2 minutes.
On YouTube.
Yep.
Yes,
don't forget
please.
hit the thumbs up button there on the YouTube window if you don't mind, guys. Let YouTube know that you're enjoying the content and the effort put out there, and don't forget to share it on your social channels if you think your friends and colleagues and family would also enjoy this madness that this great team does.
It's always fun. Thanks again, guys, and we will see you bright and early next week. Take care.
Bye-bye, guys. See you.
See you guys.